Good evening, students. So, as you know, today this session is basically to have a quick recap of so far what we have studied relating to few specific chapters, and we'll be covering some chapters which are part of Module 3, Direct Tax, and that is, of course, not only important from an examination point of view, but also for those who would want to practice the profession of tax and do, kind of work in relation to the litigation area. So you'll find those, kind of concepts very, very relevant, not only for exam, but also in the practical life. And you'll be able to connect those students who have undergone the articleship and have actually, handled the assessment and litigation related projects. They'll be able to, very easily connect with what we'll be discussing today. So first, we'll take up chapter 15, which is basically which is dealing with the assessment procedure, starting from filing of return of income till passing of order by the assessing officer. It also includes the reassessment or income escaping assessment. It also includes the assessment in the matters involving search and seizure. So a broad high-level overview of the chapter is given. You'll see that the first, kind of a starting point of the chapter is with the filing of return of income. The return is filed by the taxpayer. Now, there are various, kind of situation-related sections, as we all know. One is a regular income tax return, which is filed on or before due date under Section 139(1). The section covers various due dates for different class of taxpayers, be it individual, HUF, partnership firm, AOP, BOI, corporate entity, LLPs. Then the requirement relating to, for certain class of assessee, it is mandatory to have a permanent account number. So that is legislated in Section 139 capital A. We also have the provision which specifically, gives a mandate that who will be the person authorized to verify the return of income. For simple understanding, you may assume that the person who is authorized to sign the income tax return, that is provided in Section 140. Then the concept of self-assessment. Now, the whole concept of income tax return filing is based on the concept of self-assessment. One is required under the law to self-assess his tax liability and file the income tax return. Now, this is so far as the filing of information with the department is concerned in the form of income tax return. Then we'll be discussing Section 142. As you all know, the section empowers the assessing officer to call for certain information in connection with cases wherein the taxpayer has filed the income tax return, and it also covers the cases where the assessee or taxpayer has not filed the income tax return, and what is the objective of this section. Then we have Section 143. Now, broadly, Section 143 covers two aspects. One about a summary assessment, where the return which is filed by the taxpayer, it goes through an scrutiny through a computerized software or a system, and that assessment is done by a software itself, which is operated by CPC, Centralized Processing Center, and certain kinds of discrepancies which are identified in the return of income, those are highlighted, and an intimation you might be able to recollect. You might have seen an intimation issued under Section 143, Clause 1, which basically compares the income which is reflected in the return of income filed by the taxpayer and the income which is assessed by the department under Section 143(1). So the system itself does the preliminary checks, arithmetical accuracies or inaccuracies, or any kind of flaws which can be detected through automated softwares. Now, those are intimated to the assessee under Section 143(1). Then we also have 143(2) and 143(3), which talks about the comprehensive scrutiny assessment procedure. We'll also talk about briefly Section 144, which talks about the best judgment assessment. That is, in a scenario where the assessee is not furnishing the income as is required, or he has not filed the return of income, or in a case where the assessee or taxpayer is not cooperating with the department. Now, in such cases, the law provides wide powers to the tax officer to undertake an assessment on the basis of judgment and to the best of information and knowledge available with him. He can pass an order, and that is also called as an ex parte order, where the assessee is not cooperating. We'll also discuss briefly about the faceless assessment. So probably you all must be familiar with the faceless terminology as such, because these days all the assessments are happening except in certain situations and cases which we'll discuss in detail. The income tax scrutiny assessment these days is nowadays conducted completely in a faceless environment, where you don't know where your jurisdictional officer is. I mean, where the officer is situated, who the officer is, who is conducting your assessment or handling your tax matter. You might be able to see your jurisdictional officer, who may be located in the same city or vicinity, but the person who is actually conducting the assessment, you are not aware. The cases are randomly allocated to the tax officers across the length and breadth of the country. Then we have reference to dispute resolution panel, section 144C, which mainly covers certain situations in which the assessment will not be completed and assessee will be given an option of approaching the DRP. So once your matter is selected for assessment, and if you face, for example, a transfer pricing adjustment or addition due to reference to the transfer pricing officer, in that case, the officer will not pass a final assessment order, he'll pass a draft order, and then that draft order would be subject to a review upon an application or an objection raised by the taxpayer before a higher authority, which is dispute resolution panel. We'll deal with this section in little detail as it is important. Income escaping assessment. So we are familiar with this concept. This is basically a reassessment, or another word for is income escaping assessment, or a reopening, whatever you call it. It is contained in section 147 to section 151. And then lastly, we'll have assessment for search cases and certain other miscellaneous provisions like timeline for completion of assessment in case you wish to pass a rectification order either by the assessing officer or by the upon an application made by the assessee. An order can be rectified, and in what situation, that is contained in 154, and certain other miscellaneous provisions. So let us now considering the apart from the assessment procedure, we'll also deal with chapter relating to appeals before higher authorities, and we'll also be discussing the revision proceeding. So we have a lot of things to cover in today's session. Probably what we'll cover is somewhere around 200 plus pages of the content which is there in the study material, and we'll also be doing certain case studies and question and answers separately. So how I have divided or organized this session is that we'll be talking about only certain key concepts. So what are those key concepts? Now, basically, the sections which requires a detailed discussion due to complexity or due to its practical importance, and as well as an examination importance point of view. While everything is important from an exam point of view, but certain set of questions which are kind of touched upon frequently due to their practical importance and importance in the practice, we'll discuss with those sections in great detail, or probably those sections as well where there has been a recent amendment or there are certain controversies. So for example, section 139(1), and that talks about the return filing due dates for different class of taxpayers. So we have discussed this section in great detail in our earlier session. So for now, we are skipping it. But once we have the case studies and wherever we touch upon any of these sections, at that point of time, we will probably revisit it. So let us discuss, you all are aware about the regular return filing. So let us first discuss the case involving return of loss. Now, section 139(3) is a specific section that deals with filing of return of income in case there is a loss. Now, the section carries a lot of importance. What it says is basically, in a layman's term, if I say that if an assessee has incurred a loss in certain cases which are mentioned therein, and if he could not file the return of income within the due date specified under section 139(1), right? In that case, the assessee will not be permitted to claim the loss which he has incurred, even if the loss is genuine. He'll not be allowed if the return of income is not filed within time. Now, what kind of losses could not be claimed if the return is not filed within the due date specified? Now, those losses are, number one, the business loss under section 72(1). Then we have speculation business loss, loss from specified businesses under section 73 capital A, loss under the head capital gains, whether it is short-term or a long-term, doesn't matter. Both are covered. Loss from the activity of owning or maintaining racehorses. Now, it's important to see here that if you have incurred a loss under the head house property, or if it's a case involving an unabsorbed depreciation for which we have got indefinite timeline, as you all know. So for these two categories of losses, you are still permitted to carry forward these losses even if the return is not filed within time, and this exception has been carved out for these two. And for rest of these losses, I mean, the section is very specific, and therefore, if the return is not filed, you are not entitled to claim the loss. Then we have another category of belated return of income. Now, if the assessee is not filing his return of income within the time limit prescribed for different class of taxpayers, in that case, the return can be filed subsequently, and that return can be filed under section 139(4). So when you see any ITR form from ITR 1 to ITR 7, you'll see that the first page of the ITR, the assessee is asked under which section you are filing the return of income. So if you have not filed your return within 139(1), you choose the second category, which is 139(4), that is after due date, belated return of income. Now we know one of the consequences for belated return is that you cannot claim the carry forward of losses, and therefore those losses will lapse. Now, the important question is, say for example, if I have incurred a loss in year 1 and I have filed the return of income within the due date prescribed under section 139(1). Now that loss, let's say it's under the head PGBP, business loss. I have incurred the loss, I have filed the return in the year 1 on time, so that loss can be carried forward up to 8 years. Now in the second year, I have again incurred a loss and I could not file my return of income within the due date. So logically, I, for that year, cannot carry forward the loss. But it's important to remember that the loss which I incurred in the year 1, that can still be carried forward. Why? Because the section talks about the loss for that year, right? So therefore, if I have the brought forward losses, which are validly brought forward due to filing of return of income within the due date, I can still carry them forward, even if in one of the year I have incurred a loss, or even if it's a profitable situation and I could not file the return on time. So in subsequent years, I can take them, carry them forward. Furnishing of belated return of income. Now, what does this section says? Any person who has not furnished a return within the time allowed under 139(1), he may furnish the return for any previous year at any time, but before 3 months prior to the end of the relevant AY. So for example, if my previous year is 24-25, I can file the belated return of income before 31st December or before completion of assessment, whichever is earlier. Now, just deviating slightly from this point, if you see, we recently had a return filing season, I think that is also continuing, where the government had extended the date of filing of return from the earlier, which was for regular cases, those non-audit cases, the tax filing due date was extended to 16th of September. First, they made it 15th September, then one extra day was granted. For audit related cases, they have, twice extended the due date, and they have now made it 10th of December. Now, the question that arises is just a practical question, whether that has got any impact on the due date to file the belated return of income. Now, if you see the section and read the section as it is, the section is not at all dependent upon what was the original filing due date, or there is neither any kind of conditions precedent relating to the original return of income. It simply says that if you have not furnished the return within the time allowed under 139(1), then you can file it before 3 months prior to the end of the relevant AY. So for financial year 24-25, my assessment year is 25-26. Now the assessment year closes on 31st March 26. So 3 months prior, the date falls on 31st December. So irrespective of what the original date is or to what date it gets extended, the section says 31st December 2025. Now, we have a situation now where 10th of December, this is an exceptional year, not a routine. The government had extended the date to 10th of December, but at the same time, the return filing date, the belated return filing date continues to be 31st December. Now, this is only for the information purpose. However, for examination point of view, unless the questionnaire has specifically asked, given these situations, one will have to go with the general understanding, that is, what is the due date as prescribed under the original law. Now, what are the consequences of belated return? Now, we all know the first one is quite obvious. Certain losses computed under the specified section cannot be, certain losses computed under specified sections cannot be carried forward and set off. You will face the consequences in terms of interest under section 234 capital A. Then there's a penalty, or a fee under 234 capital A, which is 5,000. And if your income doesn't exceed 5 lakh, then the penalty, or the fee amount cannot exceed 1,000 rupees. And then certain deductions, which are income based, cannot be available to the assessor. And yeah, one more important thing, assessee cannot opt out of section 115 BAC while filing a belated return. He'll have to file the belated return as per 115 BAC only, which is the new tax regime. So let us now discuss the important concept relating to, so we'll just briefly touch upon why there was a need to, introduce section 139(4)(c), a very brief logic. The section basically talks about, and it actually mandates, that certain class of associations, trusts, or organizations, they have to compulsorily file the return of income. Now, if you read the basics of section 139, it simply says that assessee whose income doesn't exceed the maximum amount not chargeable to tax. So the criteria or the mandate for filing the return of income for certain class of assessees, except company, is that your income should not exceed the maximum amount not chargeable to tax. Now, in certain class of cases like these, where it is a case of an association, a research association, or if it's a fund, trust, university, what they were doing is that they were seeking the approvals under section 1023(c)(6) or under different exemptions and deduction provisions like section 11 to 12. And they were saying that, okay, because our income is completely exempt, or we are claiming 100% reduction and our income reduces to nil or negligible, we are not crossing the basic exemption limit, so we are not filing the return of income. CBDT said, wait. If you take a claim that, okay, your income doesn't exceed the maximum amount or the basic exemption limit, and therefore you're not filing the return of income, that argument ideally should not work, because, see, the assessing officer can verify your claim of exemption only if you have filed the return of income. So the section was specifically introduced to address those situations where, if it's a taxpayer, which is an association, AOP, BOA, or any kind of institution which is exempt or approved in whatever sections, now those sections have been specifically specified, they will have to file the return of income irrespective of their income limit. So this is a brief background. So now all of them have to file the return of income so that the department can verify the genuineness of the claim. Revised return. Now, if any person having a furnished return under 139.1, which is regular return, or 139.4, which is belated return, if he discovers any omission or wrong statement. Now, two things are important to note here. One is a person has filed the return under 139.1, that means it's a regular and timely return. And second, 139.4, that means it is a belated return. Earlier, the situation was that you can't revise the return if it's a belated return. But later on, very recently, they amended the section to also cover a situation where if the return is belated, even that can also be revised. Now, that step is quite logical. Why so? If you see the purpose of section 139.5, the purpose is that if an assessee discovers any omission or a wrong statement. Now, what do we mean by the term omission or a wrong statement? So anything which you have disclosed in your return of income or which is wrong, or anything which you are supposed to disclose, but you omitted. Now, what is important in these two terminologies is that it has to be a case of a bona fide omission or a bona fide wrong statement or a mistake. So if your case is such that it is held that the omission was not bona fide, it was either deliberate or it was out of negligence. In that case, you can't revise the return. Now, there are some section of cases where let's say due to workload, you can simply file a return of income showing 1 rupee as an income and keep all the schedules blank. And later on, that gives you, an opportunity to file the revised return. If the answer is yes, no. The answer is clearly no. You can't revise it because here the intention was only to buy more time, which is not permissible under law. Let's say a case where assessee has incurred a loss. He has no time to file the return of income. He's almost on the last day. He can't fill the lengthy schedules of the income tax returns. So he simply files the nil return without showing anything so that, he can claim his loss and subsequently wishes to file the revised return because you can really continue to claim the loss if you file a revised return. Now, in that situation, it's unlikely to get the benefit of this section. Why so? Because the original return which you are seeking to revise is actually not satisfying the conditions, two conditions, which is it has to be an omission or it has to be a wrong statement, and both of which are bona fide. So that's very important to note, which majority of the kind of students fail to differentiate, and only in those situations you can file the revised return. So I think the timeline is same, so we are not getting into it in detail. So let's now discuss one more, a small category defective return, section 139.9. Now, if you happen to file the return of income and subsequently, if there is a defect, now what could be the defect? It could be, let's say I filed the return, but I forgot or to pay the income tax. So without making payment of tax, I filed the return, or I paid the tax, but the challan number or BSR code or whatever information that I had furnished, it's wrong. So in those cases, it's likely that the CPC might, send you the return back and ask you to rectify the defect within 15 days, 30 days, or whatever is the prescribed time. And if you fail to kind of rectify the defect, then it will be deemed that as if assessee has not filed the return of income. So that's the major implication of this section, and that, often it is seen that it may also lead to the comprehensive assessment or a reassessment. So we are not discussing each of these aspects because we already, in our previous session, which is also available as a recording, we have discussed this in great detail. So permanent account number, I think that's fine. For now, we need not get into this topic. Just let me just go to the section. Quoting of Aadhaar number, so that's fine. So section 140, which is, again, it's important from a practical point of view. One needs to understand who can sign the return of income. If I am an individual taxpayer, can I ask my chartered accountant, okay, you file the return of income on my behalf and you sign the return of income? If yes, and then in what circumstances? So this is all covered. So the law simply says that if in case of an individual, it is the individual who will have to, kind of verify his return of income. So it is the individual himself. And in case of an HUF, the primary responsibility is on Karta, or if the Karta is not there, or he is absent from India, then any other adult member of the HUF, or if he is incapacitated, then again any other adult member. So in case of company, a managing director, in the absence of any MD, or there's no MD, then director, who is authorized by the board. So then there are certain situations. I'm not discussing them because it is quite informative and we can, easily kind of go through this. As we discussed, the entire, scheme of taxation in India is on the basis of self-assessment. So one will have to determine his income by himself and then determine the tax payable by himself and then file the return of income by himself by paying the tax. So it's, kind of a self-assessment concept, which is ingrained in the law. Updated return. Now, this concept is, kind of very, very important, and it has been introduced into the law recently, in recent years, I would say. I wouldn't say last year, but yeah, recently. And it has undergone certain changes as well. Now, it's very important to understand that Section 139(8)(a) is quite different from what we discussed so far as the concept of revised return is concerned. When you file an original return or a belated return, we discussed that you can revise the return, the one which you filed under 139(1) or 139(3) or 4. Now, that is only within the due date. And the implication of revised return would be that it will substitute your original return or your belated return. And second, you are never going to be exposed to any kind of implication under section, kind of interest under section 234A. If there is any additional tax liability that you have to pay, 234A will not come into picture. Of course, B and C would be there. And in addition to that, if there is a loss which you have claimed under original return, in the revised return also you can carry forward those losses and claim those losses, and you can kind of. So as such, there is a lot of, I would say, flexibility if it's a case of a revised return where you can convert your original return to a loss return or vice versa. There's a complete flexibility. You can increase your refund, you can decrease your refund. That's up to you, provided, as we discussed, it has to be a bona fide omission or it has to be a bona fide mistake in the return of income. Now, how different the updated return is from the revised return. Earlier, the time limit to file the revised return was quite, extensive. It was additional 12 months that one used to get it, but now that has been curtailed to 31st December. So that's when the concept of updated return comes into picture. Now, what does it say? It says that any person can furnish the updated return of himself or any other person in respect of which he is accessible at any time within 24 months from the end of the relevant assessment year. So if my assessment year is, let's say, 25-26, then within 24 months from the end of the AY, that is till 31st March 2028, I can file the updated return of income. And this is irrespective of whether or not I have filed the regular return or belated return. Now, in case of a revised return, we saw that the condition is you should have either filed the regular return or you should have filed the belated return in order to revise it. Now, in case of an updated return, one of the first distinction and a major distinction is that you can file an updated return even if you have not filed the return under section 139(1) or 139(4) or even revised under 139(5). So if you have filed or have not filed, doesn't matter. you can still file the updated return provided you satisfy the timeline related conditions. The provisions of updated return will not apply if the return of such person for that assessment year is a loss return. Or now this is very important. You can't really file the updated return if the return of such person for that AY is a loss return, or if it has the effect of decreasing the tax liability which you declared under section 139(1), that is regular return, or 139(4) or 139(5), that is belated and revised return. So if you have already filed a return and subsequently you want to file an updated return, yes, you can do that. But if the result of filing an updated return is a situation where you decrease your tax liability, sorry, we can't allow you to file an updated return, is what the loss is. And likewise, if you have claimed a refund and now you want to file the updated return with a kind of a more refund, you can't file it. Additionally, no updated return shall be furnished in the following scenarios. Now, that's also quite, interesting and logical. Now, say where a search has been initiated under 132 or books of accounts have been requisitioned under section 132 capital A, where the survey has been conducted under 133 capital A, where a notice has been issued to that effect. I'll just come to the main point here. Where a person has already furnished an updated return, where any proceeding for assessment, revision, reassessment, recomputation are already pending or it has been completed for the relevant AY, where the AO has information in his possession for the relevant AY in respect of person under these specified acts, which is the Smugglers and Foreign Exchange Manipulators Act, the Prohibition of Benami Property Transaction Act, PMLA Act, Black Money Law, and the same has been communicated to him prior to the date of furnishing of return. Now, what it essentially says is, and it boils down to only one thing, that if you have already been caught by the department under these draconian laws, for example, Black Money Law, Prohibition of Benami Property Transaction Act, FEMA, or kind of the revision income assessment already is happening or it's pending, or if it's a case involving such. Now, then probably you should not have any recourse to filing of an updated return. So once you are caught under any of these situations or proceedings, you are not allowed to file the updated return for that relevant assessment year, which has been subject matter of these proceedings. And likewise, the fifth one says where the information for the relevant AY, it has been received under section 90 or 90A, or it has been communicated to him prior to the date of furnishing of updated return. So what does section 90 and 90A say? It says that the government of India can enter into a tax treaty, or what we call it as a double tax avoidance agreement, with any foreign jurisdiction. And it can, under that tax treaty, will have an authority to either share the information or to receive the information. So if these are the situations where, pursuant to section 90, the government is called for certain information from a foreign jurisdiction relating to a taxpayer who is taxable in India, and the same has already been communicated to him. And in that case, you really can't file an updated return relating to that year. And lastly, if any prosecution proceedings under the provisions are, ongoing in your case. Updated return can be filed if the original return is a loss and updated return is a return of income. Now, what does simply says? It says, if in your original return you have claimed a loss and now you are claiming an income, or let's say it also includes a case where in your original income, the return of income, you have declared, let's say, 1 lakh rupee as an income, and updated return, you want to declare 1,50,000 additional. So in a case which results into increase in your tax liability, or it results into decrease in your losses, you can really file an updated return. So then there are tax consequences on the updated return. That means you are supposed to pay certain additional tax interest before furnishing an updated return. So we'll, in the interest of time, we'll not get into it. Let's jump on to So this is just, a brief about what would be the additional implications if you file an updated return. If such return is furnished after expiry of time available under 139(4) and 5 and before completion of period of 12 months from the end of the relevant EVA, then 25% of the aggregate. Now, this is an additional income tax liability over and above what you regularly in what you compute in a regular situation. You'll also have to multiply this by 25%, and that extra 25 you have to pay if you file the return before completion of 12 months from the end of the relevant EVA. Let's say if you could not file within 12 months, and then it says that within 24 months, if you file it, then it becomes 50%. Now, so let's say we have completed the first phase of assessment procedure, which is an obligation of the taxpayer for giving the information in prescribed form, which we called as IT return or ITR. And we discussed due dates. We didn't discuss due date, but yes, we discussed the concepts which are important in the context of filing of return of income. Yeah. So once you file the return of income, in that return goes through, as I discussed earlier, it goes through kind of an automated verification that is conducted under section 143(1). So let us first discuss 143(1) and then we come back to section 142 and 142(2)(a). Yes. Now, one 143(1). Now, this is also called as a summary assessment, where you file the return under 139 or in response to the notice under 142(1). Now, please note that the section gives reference to section 139. It doesn't say 139(1) or 2, 3, 4, 4A, 4C, or 5, or even 8A. It simply says 139. So that means it covers the entire gamut of subsection or clauses that are part of section 139. Or second situation where the return is filed in response to notice under 142(1). That means the officer has issued the notice calling upon you to file the return. Now, in that situation, the return shall be processed under 143(1). Now, thus, the summary assessment, commonly referred to as an intimation, it's a computerized preliminary assessment or processing of the return of income. Now, what does section 143(1) does, or what's the scope of this section? 143(1) provides for computation of total income of an assessee after making certain adjustments. Just have a look at it, what kind of adjustments are done. Now, one of the most, kind of important aspect here is that what is common among all of them is that it is merely based on what the system or a computer can identify. Arithmetical error means totaling errors. Incorrect claim if it is apparent from the intimation in the return of income. So if there is any claim of expenditure or if there is any deduction which apparently seems to be wrong, that can be eliminated. Take an example of an assessee who is filing an audit report. Now, in an audit report, if an assessee has, let's say, not opted for 115 BAA or BAB section. So that means he is filing his tax audit report and supposed to file his return of income under the normal provisions of law without opting for any concessional tax regime, because that is one of the clauses in the tax audit report. Now, when you file the income tax return, let's say you compute your tax liability erroneously by opting for 115 BAB or BAA. Now, in that case, the system itself will detect this error by comparing your return of income with what you have submitted in the tax audit report. And likewise, whatever information about additions or adjustments or deductions that you submit as a part of tax audit report, they are also reconciled with your return of income, and the system itself will throw some errors. For example, you have certain income in your 26 years which you have failed to claim or failed to offer in your return of income. It will throw such information by way of issuance of intimation under 143(1)(a), and it will ask you to pay the tax which is due. Now, it's also important to note that Section 143(1) does not necessarily result into any adjustment. Even in the cases where there is no tax liability, the return which you have filed and the assessment which is done under 143(1)(a), it might be possible that there are no differences. Both are exactly same without any errors. Even in such case, the department might issue 143(1), and it's necessarily just a preliminary confirmation that apparently there are no any errors, deviations, or adjustment that are required to be made. But it doesn't mean that your assessment is complete. Wait, you have still 143(3), which is there, and the income escaping assessment provisions which are applicable. Now, what is the statutory timeline? An intimation is required to be prepared and generated and sent to the assessee within a period of 9 months. Now, that is a statutory time limit, that 9 months from the end of the financial year in which you file the return of income. Let's say, for example, for financial year 24-25, I filed the return of income on 15th of September 2025. By what time the department can issue an intimation? So, 9 months from the end of the financial year in which the return was made. So, I filed the return pertaining to financial year 24-25 on September 2025, 15 September 2025. So, the year ends on 31st March 2026, the year in which I filed the return. 9 months from the end of the financial year. So that means 31st December 2026. By that date, the department is supposed to issue the intimation. If there are any questions, please provide the questions in the chat box. I hope it's all accessible to everyone and visible. Or you can also, kind of raise your query by asking the question directly. All right. Now, let's talk about the regular assessment. Once the return is processed under 143(1), or irrespective of whether it is processed or not, the Income Tax Department reserves the right to conduct a detailed verification of your return of income and your state of affairs. These days, the kind of question that they have been issuing during the course of assessment, and particularly in cases which involve reassessment or a search matter, is extremely interesting. In fact, in some of the taxpayers' cases, they might also ask you about what is your expenditure, personal expenditure, which as such you will say what they have to do with the personal expenditure. If I am incurring, let's say, 5 lakh rupees on my vacation to Europe, now logically I have not claimed and I'm not allowed to claim it as an expenditure in my books of account. But they still ask about the details of personal expenditure. And the logic is that if you spend 5 lakhs or 50 lakhs, whatever it is, what is the source of such spending that they would want to verify so that they can kind of uh, say that, okay, it is justified in line with what you have reported. If I'm a taxpayer earning income of 10 lakh rupees, having a family of 5 members, and I'm the sole breadwinner, for example, in my case, I'll have my survival expenses, I'll have my living expenses, I'll have my EMIs, I'll have my normal investment, I'll have education of the children. So all of this is there. And if they find that, okay, you have spent 20 lakhs for a family trip to Europe or to any of the countries, then definitely it calls for some questioning and some verification. So it's not that what is contained in the return of income is the only basis to select your case. It could be beyond what is there in the return of income as well. So regular assessment or a scrutiny assessment. Now notice under section 143(2). One of the most important aspect is the notice under 143(2) has to be served. In some section, you might have seen 143(1), it's about issuance of intimation. And likewise, on many places, you will see that what is required is the issuance of notification. The 143(2) is such section where the language is served. So service of notice is important. But nowadays, the concept of service of notice as such has been a redundant concept. Why? Because the time between issuance of notice and service of notice is almost not there or non-existence. It is happening on a real-time basis because everything has been done through a system. So it is the NFSC, Faceless Assessment Agency, National Faceless Assessment Center, that is kind of selecting your cases and issuing the notices, and that notice is dropped in your login credentials on the income tax department, and immediately it is sent on your email ID with a WhatsApp message, okay, that you have been issued a notice. So earlier it used to be a face-to-face assessment, and additionally it was all about serving the notices through speed post or some courier, the postal services. So any kind of non-service of notice used to invalidate the proceeding. So there was a lot of significance of the word service earlier, but now that is there in the law, but for all practical purpose, it is going to be of less importance as such. So what is the timeline? The timeline is very important. Within 3 months from the end of the financial year in which return is furnished or filed. So if I file the return 15 September 2025 for the financial year 24-25, then the department can issue me the notice under 143(2) within 3 months from the end of the financial year. That means by 30th of June 2026, they can issue the notice. So coming to the best judgment assessment. Now, why there is a need of this section, it's also important to understand. Best judgment assessment is attracted not as a blanket rule. It is only when one of the conditions are satisfied. What are those conditions? Number one, the assessee has not filed the return of income under 139(1), that is a regular return of income, or a belated return or revised return under 139(5), or an updated return. So there is a failure to file the return of income. Second, the assessee has filed the return, but he has failed to comply with the terms of notice. That means the department has issued a notice under 143(2) asking for certain information. but the assessee has failed to file a response or the response filed is not adequate. Third, assessee fails to comply with all the terms of notice issued under 142.1. 142.1, the title of that section is Inquiry Before Assessment. So if the assessing officer is issued a notice under 142.1 and the assessee has not filed the response or failure to comply with the terms of notice, or 142.2a, which basically deals with a special audit, if again you have failed to comply with this section, now this is not cumulative, it's either or. If there is a failure and that failure is not isolated based on facts and circumstances, the officer is able to make out that, okay, I have issued a notice, but assessee has not filed the return of income. I have issued a notice again. In practice, they issue the notice, frequently before coming to the situation of making a best judgment assessment or an ex parte assessment. If that is the case, then AO shall, now it is mandatory, it's not optional. The law says AO shall make a best judgment assessment. That means an assessment to the best of his knowledge and information, and after taking into consideration relevant material which he has gathered. Now, best judgment assessment does not mean that one has to, because the word itself varies from person to person. The judgment according to me in a particular case could be different from the judgment according to you or according to X, Y, Z. Everybody might come on to the different result. But what is important is that if there is a failure on the part of the assessee in any of these situations, the AO has to take into account all the relevant material which he has gathered. Now, if you also come across such a practical situation where the assessee is not cooperated, all right, fine, that is an admitted fact. The department goes for a best judgment assessment. That's also fine because the section mandates. But then there's also a mandate of section that after taking into account relevant material which the officer has gathered. So without a material which is available on record, or he cannot go beyond what is there available on record. So that's also important. And secondly, an opportunity of being heard. So logically, it is only when the opportunities have been given to the assessee and assessee is not complied with those opportunities that AO will make a best judgment assessment. But still, once the best judgment is resorted to under 144, a final warning or an opportunity needs to be given to the assessee to justify why it cannot be. So that's what we discussed. Now, there is an exception, opportunity of being heard, where a notice has been issued prior to making of an assessment. It is not necessary to give an opportunity. So if your officer has already issued a notice under 142.1, then he need not again give an opportunity. That's the only exception. Faceless assessment. So as I mentioned that earlier, the assessment used to happen face to face. You know your jurisdictional officer. The same jurisdictional officer will conduct an assessment. He call upon the assessee to visit the department. He will call upon assessee to explain the facts. But back in 2015, the government issued, kind of the provision. The complete revamp of the system was undertaken where they moved gradually from face-to-face assessment to a faceless assessment. Now, the first step was in this, technology, because of technology, the first step in this was to introduce an email-based assessment where the assessee, without visiting the department or without filing any heavy document, physical paper, he can simply email the documents. So there was no need to visit the office. And that was limited initially to few categories of assessees or class of taxpayers. Then they moved from email-based assessment to a system-based assessment where you can upload all your documents on the portal, but still you can see that, yes, it is the same jurisdictional officer who will conduct an assessment. And if required, you can ask for a physical hearing or a virtual hearing or a face-to-face hearing. Then they advanced further and they introduced a faceless assessment, which means you don't know who is your officer conducting the assessment. And yet, your jurisdictional officer is still there. The only change is that the National Faceless Assessment Center will pick up your case and it will randomly allocate your case to any assessing officer in any part of the world. So if you are, let's say, in Bombay, and if your jurisdictional officer is in Bombay, it is not necessary that the same officer will do your assessment. The case might be assigned to somebody in Gujarat, somebody in Kolkata, somebody in Bangalore, to any assessing officer, and you will not know where the case is or with whom the case is. What is the procedure? So that is, I think, defined. I'm not gonna kind of read it word by word. Just have a look at it. Just go through the headings only, and wherever you find that I need to explain it in detail, just let me know. So first step is the random allocation after picking of the case. Then the assessment unit will, kind of through NFAC, it will issue an inquiry letter asking for plethora of information. Now, then there is a verification unit where if the request for conducting certain inquiry or verification has been made by assessment unit, then the NFSC will in turn assign that request to the verification unit through again an automated allocation system. So there will be two set of officers who will be, one is an assessment unit, another is a verification unit. The third one is a technical unit where if any kind of technical assistance is needed by the assessment unit, then the matter again will be referred to the technical unit, but the original or the assessment which is ongoing will still be conducted by the assessment unit. Technical unit will just be there to assist the assessment unit. So for example, if there is any area where a legal research is required or a position is required from a consistency point of view, then probably the technical inputs can be obtained from a technical unit. Once the matter has been, reported to verification and technical unit, then as per the requirement, the process will be carried out by them, and they'll again internally they will issue a report to the assessment unit. So this is about failure on the part of the assessee. Let's say if the assessee fails to comply with the notice, so as we discussed, the assessing officer reserves the right, and in fact, it's not a discretionary thing, as the law uses the word shall. It is mandatory for the assessing officer to conduct the assessment in terms of process prescribed under Section 144. By using and gathering all the relevant material and information, he has to pass the assessment order to the best of his judgment. So best judgment assessment or an ex parte order is also there if the assessment is conducted in a faceless manner. So since we already dealt with this provision in our earlier lecture, I'm not discussing word by word because we have a lot of things to cover. We'll just simply jump on to certain other important provisions. If there is anything that you need to understand in detail, please feel free to type your query into the chat box so we can take it up here. So let us now discuss reference to dispute resolution panel. Yes, section 144C. Now, as I said earlier in the beginning, this section is important not only from an exam point of view, but also those who want to practice the taxation law. Now, what does the section talks about? Now, we all know that once you file the return gets processed under 143.1. We call it summary assessment. If your return is picked up for scrutiny, you are served a notice under 143.2. And then if the notice is issued under 143.2, then within the prescribed timeline, the officer concerned is supposed to pass an order under 143.3.3. Now, there are certain cases wherein the assessing officer makes a reference to the transfer pricing officer in case the assessee has been subjected to transfer pricing proceedings. In those cases, as well as the case where assessee is a non-corporate, non-resident, or a foreign corporate. Now, in these two situations, if there is any order which is likely to be passed, in that case, that order shall be passed and it will be called as a draft assessment order. That means if your assessing officer has selected your case for scrutiny assessment and the matter has been referred to the transfer pricing officer for conducting the TP assessment, or if you are an assessee who is a non-resident, non-corporate, that means, to simply put, it's a non-corporate or a non-resident, or if it's a foreign company. In that case, any adjustment, whether the transfer pricing adjustment is there or not, or in case of a foreign company, whether it's a normal corporate tax adjustment or if it's a transfer pricing adjustment, doesn't matter. The assessing officer is supposed to pass only the draft of the assessment order. He is not supposed to conclude the assessment proceedings under 143.3. Now, the draft assessment order can be challenged before the forum, which we call it as dispute resolution panel. Now, the DRP consists of 3 commissioners. Now, those 3 commissioners, within the time-bound manner. Now, we all know the process of filing an appeal before CIT appeal and all the concerned provisions we have already discussed. Now, this commissioner appeal process is an appellate jurisdiction, which comes in the regular course. But DRP, for certain class of cases or certain class of taxpayers, is an alternate. It's not mandatory, it's an alternate. So one can approach the dispute resolution panel, file an objection against the draft assessment order, and within 9 months, the DRP will pass a direction to the assessing officer to dispose of the matter as per the directions given by the DRP. The only major benefit of DRP is it's a time-bound process and the commissioner will have to pass an order within 9 months. Once they pass an order, if the assessee is still aggrieved by the order of assessing officer based on direction received from DRP, he can directly go to the ITAT by filing an appeal. Whereas in case of CIT appeal, usually and in practical experience, it's seen that there is no time-bound mechanism, and the CIT appeal generally disposes of the matter at a much higher, in a much, due to the procedural aspect and a lot of workloads, the matters are taken up on turn-by-turn basis, and it takes a lot of time. In some cases, it might take 2 years. In some cases, it might take 5 years and 7 years also these days. So those appeals which were filed in 2017, you will find that those cases may still be pending with CIT appeal. So that's why they introduced back in 2008 the section 144C, and that section 144C is basically to fast track or expedite the cases which relate to non-resident or a foreign company or the matters involving transfer pricing disputes. Now, what are the options available in terms of process? Your scrutiny assessment is selected, matter is referred to TP, TPO passes an order, the order is received by officer concerned, officer will pass a draft assessment order, the draft will be communicated to the assessee. Now, assessee has 2 options, he can either accept. If he's accepting, then the matter is over, he will pass the final assessment order thereafter. If the assessee doesn't accept, that means he has an option either to file an objection before DRP and intimate the assessing officer. And if he doesn't wish to file an objection, in that case, he can communicate that, okay, fine, I'll be preferring an appeal before CIT appeal so that assessing officer can finalize the assessment and pass an order under 143.3. So if you do not opt for dispute resolution panel, it doesn't mean that there is no alternate available. You can still opt for the normal appellate jurisdiction, which is Commissioner of Appeals. The assessing officer has to complete the assessment on the basis of draft assessment. As I said, if the assessee intimates the acceptance, or if no objection is received within 30 days from the assessee, in that case, the AO can finalize the assessment. Now, irrespective of the timelines which are given under 153 or 153B, the assessing officer will pass an order within 1 month from the end of the month in which the acceptance is received or the period of filing of objection expires. Now, the DRP will pass in case where objections are received. They'll issue the directions for the guidance of AO to enable him to complete the assessment. Now, those directions are given to the assessing officer, and those directions are binding in nature. Assessing officer has to follow compulsory those directions and pass an order in accordance with those directions. And thereby, if the assessee is still aggrieved, we can approach an ITAT. The DRP has been given wide powers. They can make further inquiry before giving any direction, or they may also issue direction to any income tax officer to carry out further inquiry in connection with the objections filed by the assessee. Now, what could be the outcome? Once you file an objection before DRP, the DRP may confirm the addition, he can reduce, he can also enhance. So the powers are wide. It can be same status quo, no change. It can be deletion. It can be enhancement. It can be reductions. The most important aspect is it cannot set aside. Now, what is set aside? Set aside means the DRP can completely ask the assessing officer to set to set aside the order which has been passed and issue any direction for further inquiry. So you can't set aside. That power is available only to the tribunal. So then rest of the points are, I think, kind of self-explanatory. We'll not be getting into it at this moment unless the students are having any specific questions. The time limit, again, very important. It has to be 9 months from the end of the month in which the draft order is forwarded to the eligible assessee. Now, this takes us to a very important chapter. Lot of importance for those practicing the income tax law, that's called as income escaping assessment reopening. And in all view, this concept relating to reassessment was there in the 1922 Act, Income Tax Act 1922. That is probably 100 years back. The same concept was incorporated into the law when Section 1961 Act was enacted. The provisions relating to reopening have largely been settled due to probably thousands and thousands of judicial decisions and judicial precedents in connection with Section 147 to Section 151. You'll find thousands and thousands, probably millions of judgments around this section. And the law has matured a lot. It has recently undergone, back in 2021 and 2020, 4 years back, a significant revamp. And that revamp is basically, to some extent to codify what has been legislated by the judiciary. What has been pronounced by the judiciary, the principles which are emanating from the judgments by the Supreme Court and various high courts, and to some extent to overrule some of the judgments. So what does the law say? It in fact expands the timelines, the scope of section, and to the lot of concepts that are inbuilt into it. And what is the purpose of this section? The purpose of this section is to kind of capture those cases which have escaped the assessment. If the assessee has filed the return of income, it has not been picked up for scrutiny, then AO can invoke 147 to 141 to do the reopening. If the matter has been selected for scrutiny, but during the course of regular assessment, a particular issue could not come into the attention of tax officer, so he can revisit it and he can probably invoke section 147 to 151. And likewise, in cases relating to search, one can invoke 147. So let's see how the concept is and what are the kind of important areas. I'm not getting into in detail what is the difference between what was prior to 2020 and what is post 2020. So largely because that is of no relevance to you. At some point of time, I might refer to it in brief just for academic interest, but let's read the section as it is. If any income chargeable to tax in case of an assessee has escaped assessment for any assessment year, the assessing officer may, subject to the provisions of 148 to 153, he may assess or reassess such income or recompute the loss or depreciation allowance or any other allowance or deduction for such assessment year. The assessing officer may also assess or reassess the income in respect of any issue which has escaped assessment, and such issue comes to the notice subsequently in the course of proceedings under this section, irrespective of the fact that the provisions of section 148 capital A have not been complied with. Now, what the section simply says that if any income has escaped assessment, then the AO is supposed to follow certain process which is given in section 148 to 153. Now that process is basically mainly about the timelines, about the inquiries. And once that step is done, only then one can invoke section 147. The section also covers a situation wherein if the 147 proceedings have been initiated, assuming, let's say, section 148 and other conditions are satisfied, and subsequently during the course of assessment, the AO comes to the issue which was not discovered or which was not available at a time when the reassessment was initiated. Even that issue can also be covered, examined, or assessed in detail without following the process prescribed in section 148 once again. So this is also important. Just have a bird's eye view of the highlight here. So it's not only an assessment, it also is about the recomputation. So he may recompute the loss, he may recompute the depreciation allowance or any other allowance or deduction. Now, inquiry before assessment, conducting inquiry, providing opportunity before issuing the notice. Now, this section 148 capital A is a new concept recently enacted under the income tax law. Prior to that section, largely the law was that if an assessing officer wants to do a reassessment, he should have a reason to believe and he should give an opportunity of being heard to the assessee before issuing the notice under 147. So there was a notice which was issued pursuant to the directions of Supreme Court in GK and Driveshaft. The assessing officer will issue a notice. Assessee will make an objection against the reassessment if he has, and AO will dispose of the objection, and then finally he will kind of initiate the assessment. But now that same process has been codified. Instead of what was followed earlier because of the Supreme Court judgment is now being followed pursuant to the process which is now inbuilt into section 148 capital A or codified under 148 capital A. Look at the language. Now that's very important. Where the AO has information which suggests that income chargeable to tax has escaped assessment in the case of an assessee for the relevant event, he shall, before issuing any notice under 148, for providing an opportunity of being unto the assessee by serving upon him a notice to such show cause as to why a notice under 148 should not be issued in his case, and such notice to show cause shall be accompanied by the information which suggests that income chargeable to tax has escaped assessment. So that means before invoking the provisions, assessing officer has to have information, and that information should suggest that income chargeable to tax has escaped assessment for the relevancy. Now, once the AO shares a notice, the assessee will file his reply within the prescribed time. Upon receipt of reply, the assessing officer, on the basis of material available and taking into consideration the reply, he'll pass an order with the prior approval, whether he will decide now whether this is a fit case to do the assessment or not. Now, there's a difference. Under 143(2), that section when we discussed, there was no question of opportunity being given before doing your scrutiny. So officer, based on, the NFSC in largely now, the NFSC can simply issue the notice based on the system-based parameters and information that it has gathered. Without giving an opportunity, it can issue an 143(2) notice, and assessee has to undergo the complete assessment. Whereas in case of a reassessment, largely the important criteria is that before moving ahead with the reassessment proceeding, the AO need to have an information which suggests that income chargeable to tax has escaped assessment, and he has to share that information. Assessee will file a reply. Based on reply, AO will pass an order under 148(8)(d), holding that yes, in this case, whether the assessment is required or not, whether it is a fit case or not. If it is a fit case, only then he will kind of move ahead with the other steps. So this is what section 148 says. Before making the assessment, AO shall issue a notice under 148 to the assessee along with a copy of order passed under 148 capital A. Now, what is 148 capital A? Let's first look at what is information. As we saw, the notice can be issued when there is an information which suggests that income chargeable to tax has escaped assessment, and where the AO has received the information under the scheme notified under 135 capital A. We'll look at it later. Let's understand first what is information. Information in case of an assessee, first point, for the relevant AY in accordance with the risk management strategy formulated by the board. Now, this is largely through an algorithm-based system picking up your case. So, if the board has formulated a risk management strategy, based on that strategy, if your case is picked up, then that by itself will satisfy the definition of information. Second is about audit objection. Now, there are two kinds of audits that are conducted. One is a revenue audit, another is a CNG audit. Once an income tax return is filed and normal scrutiny assessment is done, then the department conducts the audit of what was, issued and asked by the AO and what was furnished by the assessee. And then there is a CNG audit, Comptroller and Auditor General of India. They also, kind of selectively verify the files based on materiality and other parameters. Now, if during those audits, if there is any issue which was not examined and which was supposed to be examined, if it comes to the knowledge of the department or any senior officer concerned, then that information will also be one of the bases which can call for the reassessment. Any information received under an agreement referred to in 1998. So we all know what 1998 is. So if any information received from the foreign government, that information will also be one of the bases that department can issue the notice calling for reassessment. Any information made available to the AO under the scheme notified under 135A. Any information which requires action in consequence of order of tribunal or court, or any information coming from the survey conducted under 133 capital A. Now, all of this will be deemed to be an information for the purpose of carrying out the reassessment. What is the timeline? Now, there are two timelines. One is about issuance of notice under 148 capital A and another is about 148. 148 capital A does not give jurisdiction to the assessing officer to conduct an assessment. 148 is the main section, I would say, where the AO can assume the jurisdiction, and one cannot issue 148A without following the process of issuance of 148 capital A. So 148 capital A comes first. That is, to simply put, it is an inquiry before carrying out the reassessment and giving an opportunity to the assessee to prove that yes, why in this case reassessment is not required. Once that is done, then AO decide whether he wants to go ahead, उसको 148 issue करना है कि नहीं करना है. What are the timelines? Notice under 148A cannot be issued if 3 years and 3 months have lapsed from the end of the relevant event, unless your case falls under clause B. So the general timeline is 3 years and 3 months from the end of the relevant event. If it's a situation involving clause B, then if 3 years and 3 months, but not more than 5 years and 3 months have lapsed from the end of the relevant event, unless AO has in his possession the books and documents or evidence relating to number 1, any asset, number 2, any expenditure, number 3, any transaction, number 4, any entry. Now, if you see, they have almost covered everything: asset, expenditure, transaction, or entry. Now, it's all subjective. Any entry. Now, what does the para say? It says, which show that income chargeable to tax, which has escaped assessment, is or it's likely to exceed 50 lakh rupees. So the first one is 3 years and 3 months, it's general. Second one is if the amount of escapement or the potential of escapement is 50 lakhs or more, and that is only based on the information in possession of AO, which could be a books of account, it could be an entry, expenditure, asset, or any evidence relating to that. If that is the case, then the time limit would increase from 3 years, 3 months to 5 years and 3 months. Now that was about issuance of 148. 148 capital A, which is an inquiry before issuance of 148A, the time limit is 3 years in general and 3 years, but not more than 5 years, where the income chargeable to tax is likely to exceed 50 lakhs. So there's a difference of only 3 months. Now, before carrying out the reassessment, as I mentioned, the officer concerned will have to issue the notice under 148. And generally, when the 148 is issued, the only question that is asked by the officer is to file the return of income. So if you have already filed the return of income, the system will prompt you to again upload the same return, or if you want to modify, there's a complete flexibility. You can file a modified return of income under section 148. Now the timeline is again given for this within 3 months from the end of the month of notice. These are the cases where it will be presumed that assessing officer have got the information. So I'm not getting into it. This is largely relating to anything which comes out of search or which is an incriminating nature. 148 capital A. Now, what is the process AO needs to follow so far as inquiry before resorting to 148 is concerned? 148 capital A. First, with the prior approval of a specified authority, and if required, the assessing officer shall conduct an inquiry. Now, if you see the word if required with the prior approval with respect to information which suggests income chargeable to tax is escaped assessment. Now, 148 capital A again is not optional. We should not be going or, so the section, the first aspect is conduct an inquiry. Now, this is only in relation to the discretionary power of AO to conduct an inquiry in relation to the information which he is already possessing. So inquiry is optional. 148 capital is not optional. You have to have an opportunity to be given to the assessing, to the assessee concerned or a taxpayer concerned. So the clause B says you have to issue a show cause notice under 148A clause B. Now this show cause notice is not for making any addition or adjustment. This show cause notice will highlight, okay, I'm having this information. Do you have anything to say? And why I should not do your reassessment. That's it. It's not a assessment order as such, which is appealable. Once you file the reply, then the assessing officer will decide based on material whether he needs to go ahead or not. Now, one question for the students. Let's say the assessee files an objection under 148A and officer passes an order under 148D, and finally it is held that yes, he will go ahead with the scrutiny assessment. I mean, the reassessment, sorry. Now, what course of action is available to the assessee? Reassessment is about to start. 148D order is received. What can the assessee do in such situation? Can he file an appeal before an order which is passed under 148D? Please mind well, this is a revisionally class. So the presumption is that we have already kind of attended the earlier session, first session, and we have gone through the material, and then we are, having this revisionary class. And this very important question: can I file an appeal before an order which is passed under 148A clause D? Anybody want to try? Okay. So there's one answer from student saying no. Okay. Any other answer with reason? All right. So the correct answer is no, as one of the student has already highlighted that one cannot file an appeal against an order passed under section 148 capital A clause D, because the if you read section 246 capital A, which contains the list of orders passed by the authority which are appealable, you won't find the mention of 148 AD. That is number one. So therefore, that door is closed. However, that does not mean that the section 148 AD cannot be subject matter of litigation. You can still file a writ petition before the High Court concerned, and then High Court uh, will kind of intervene, because the general law is that if there is no alternate remedy available under the Income Tax Act, or in any situation, if the law doesn't provide for a remedy, then against that order, one can directly approach the High Court, and High Court in that case will decide upon the case. So I think with this, we are taking a short break. We'll be back in 15-20 minutes, and then we'll touch upon some other aspects relating to appeals and revisionary proceedings and some of the important sections that might be part of the assessment procedures. And yes, of course, we'll also have a small Q&A kind of questionnaire that we'll be discussing to test the knowledge of what we have studied so far. So we'll be back in 20 minutes. Manishi? All right. All right. Yes. So now we'll be, after a quick recap of assessment procedure, now we'll discuss the provisions which are part of chapter 16, that is dealing with the appeals and revision. Now, as we all know, once the order is passed by the assessing officer, then there are appellate forums where either the assessee can challenge the order passed, or likewise, beyond CIT appeal, the department can also file an appeal before like tribunal, high court, or Supreme Court. So these are the four appellate jurisdiction. The first appeal will always lie before Joint Commissioner Appeals or Commissioner Appeals. Now, against which type or kind of orders you can file an appeal before Joint Commissioner Appeal or Commissioner Appeal, that is discussed in detail in section 246 capital X. The second appeal, which arises from the order passed by the CIT appeals, lies before the Income Tax Appellate Tribunal, ITAT as we call it. ITAT has got different benches in different cities, major cities of India, and one can simply, by logging onto the portal, can file an appeal before ITAT. The third appeal lies before the High Court. Now, of course, it is the jurisdictional High Court we are talking about. So if a taxpayer or the department is aggrieved by the order passed by tribunal, they can directly approach the High Court by way of a tax appeal. Now, please note that there's a difference between a writ petition and a tax appeal. A writ petition is filed only in certain circumstances. It is not filed pursuant to any provisions of income tax law. It is filed on the basis of certain parameters, not necessarily under the income tax law, even under the GST law or any other kind of an issue where there is no remedy available or where the principles of natural justice are compromised. And under in certain situation, there are certain prescribed guidelines where an individual or a company can file a writ petition. Whereas what we will be talking about today is about the appeal, and it's popularly called as a tax appeal that one files if one is aggrieved by the order passed by the appellate tribunal. If one is aggrieved by the order of High Court, again, whether it's department or the assessee, they can directly approach the Supreme Court by way of a special leave petition. Then we'll also be discussing the provisions dealing with the revisionary proceeding. Now, revision is something which is carried out pursuant to the direction of the CIT, and provisions are contained in section 263. So there are certain miscellaneous concepts as well. For example, the monetary limits for filing of appeal by the tax authority. Now, they have issued a circular wherein they have prescribed that a department cannot file an appeal before an appellate tribunal in case the tax effect or the monetary threshold involved for a particular matter is X amount, Y amount, and likewise before High Court and Supreme Court also there are these monetary limits. Now, those limits are only for the department, not for the assessee. So far as assessee is concerned, even if it's a matter of addition of 100 rupee, one can file an appeal before High Court, and likewise if it's a matter of millions, one can file an appeal. So irrespective of mandatory threshold, the assessee can also always challenge an order, whereas in case of department, there are monetary threshold involved. Then there are certain ancillary concepts like doctrine of partial merger and total merger, deferment of appeal by revenue under section 158 AB. So let's discuss the concepts in brief. The appeal before Joint Commissioner Appeals. Now, assessee agreed by the following orders, which could be passed by the assessing officer. He may file an appeal before the Joint Commissioner Appeals. Now, which type of orders are covered here? The first one is an order under section 143(1), which is a summary assessment as we discussed, where the assessee objects to the making of any adjustment. He can file an appeal before Joint Commissioner Appeal. Likewise, if it's a complete scrutiny, then 143(3). If it's a best judgment assessment, then 144, where the assessee objects to the amount of income assessed. So in nutshell, if the assessee is agreed by any of these orders, he can directly file an appeal before Joint Commissioner Appeal. It also covers the order passed under 147, which is reassessment. Now we discuss one question, 144, 148, D order. Now that is not covered here, and that's where you have to file a writ petition before High Court only, no option. So that order is not appealable before the joint CIT appeals or the CIT appeals. Likewise, we have section 200 capital A 201, 206C, which largely deals with the TCS and TDS related provisions. So one can, of course, approach the first level appellate authority. An order imposing penalty under penalties, okay. An order under section 154 and 155. So if it's an issue of, a rectification of apparent mistake, then again, even that order is also subject matter of appeal before the CIT appeal. No appeal can be filed before joint CIT if any of the order is passed with or by the prior approval of authority above the rank of deputy commissioner. Now, what is the logic? If you read section 246 capital A, and if you compare this with section 246(1), now largely the orders which are covered under 246(1) are also covered under 246 capital A. The only and major point of difference is that if the order is passed by an officer who could be income tax officer or an officer below the rank of deputy commissioner or the deputy commissioner also, in that case, one can file an appeal before joint CIT. But if the assessing officer happens to be an officer senior in rank, for example, if it's a case of a joint commissioner itself being an appellate authority or an additional commissioner being an assessing officer or a commissioner being an assessing officer. If the order is passed by a senior officer in rank, then the appeal will always lie before the CIT appeal. Appeals pending before commissional appeal in respect of appellable order may be transferred to joint commissional appeal. Now, this section was introduced recently, section 246, largely to deal with the huge backlog of appeal that is pending with the commissioner appeal. So the government thought, okay, let's do one thing. The cases involving the order passed by the officers lower in rank, we'll create a parallel jurisdiction of joint CIT appeal where all fresh appeals will be filed before the joint CIT appeal, and all pending appeal may also be transferred from CIT appeal to the joint CIT appeal, subject to satisfaction of these conditions. And likewise, the appeal pending before joint CIT appeal may also be transferred to the commissioner appeal. Now, before transfer, one has to give an opportunity of being heard to the taxpayer or the appellant concerned. Please note that whenever you do your communication with the department, if it's a matter of assessment, then you always refer to the taxpayer as an assessee in general. But the moment you move to the appellate jurisdiction, where you file an appeal before commissioner appeal, joint CIT appeal, or the ITAT, then you refer to the taxpayer as an appellant. So you will see that when I interact, I might use the word assessee or appellant interchangeably, but largely if it's a question of appeal, then the assessee becomes an appellant, and if it's the department, then you refer to him as an assessee. So that is customary. It is not coming out of any law, it's out of the customs. Now we saw that so far as the income tax assessment is concerned, there's a concept of faceless assessment. Now the same concept which was introduced only for the assessment purpose initially has now been implemented with full effect so far as the appeal matters are also concerned. So for all pending appeals as well as past appeals as well as new appeals, all are now covered. There are certain exceptions, but all are now covered and subject to faceless appeal scheme, where you are not aware before which appellate authority your matter is pending. You are never called upon to have a face-to-face hearing. It's all virtual and that too conducted in a faceless manner. Now coming to the orders which are appealable before the CIT appeals, Commissioner of Income Tax Appeals. Now, an assessee, deductor or collector who is agreed by the any of the following order may file an appeal before CIT appeal against such order under section 246 capital. 1. An order passed by the joint commissioner under 115 EP refusing to approve the option for tonnage tax scheme. An order against the assessee where the assessee denies his liability to be assessed under the Act. Any intimation under 143(1), 200 capital A or 206 CB1, Now, this we discussed. This was also covered under 246 appeal before joint CIT appeal. It is also being covered here. The only point of difference or the reason is, the only basis on which the appeal lie under 246 and not under 246 capital A is about the rank of the officer who is passing the order. Likewise, a scrutiny assessment order passed under 143.3, except when the order is passed pursuant to direction of DRP. Now, if any issue, as we recollect a while back, we discussed if it's a case of an assessee who is facing transfer pricing adjustment, or if it's case of a non-corporate, non-resident, or a foreign company, those are the eligible assessee who can opt for the DRP option. And if they have opted for a DRP option and the DRP gives the direction, and then officer concludes an assessment under 143.3, then again you don't have to go back to file an appeal before CIT appeal. Then the only option lies is you file an appeal before tribunal. And that's where, if you see, an order passed under 143.3.3 is appealable, except an order passed in pursuance of directions of DRP. Likewise, it also covers an order passed pursuant to Chapter 10A relating to GAR. Now, if you see, the only rationale for keeping it out of CIT appeals, purview is that CIT appeal, at the end of the day, the Commissioner of Income Tax and Commissioner of Income Tax Appeal, both of them are largely of same experience, having same particular conditions of employment, having same kind of designation. So therefore, when you want to challenge an order passed by CIT, you should appear or file an appeal only before the tribunal, not before the same level of officer. It's just that their functionality is different. The commissioner and the commissioner appeals, they are largely having the same experience. They are departmental officer, both subject to the departmental proceedings. So an order of assessment, reassessment, or recomputation under 147. So same logic, you can file an appeal to CIT appeal, except if it is pursuant to direction of DRP. So likewise, there is a list of orders with some exceptions, and all of these orders which are specified here are subject, can be appealed against before the CIT appeal. What would be the form of appeal? Now, so far as the procedural aspects are concerned, they are common for both 246 capital A as well as 246. What does it say? In case of an appeal before the Commissioner appeal or the Joint Commissioner appeal, irrespective of date of initiation of assessment, the appeal shall be accompanied by a fee of 250 rupees, where the total income as computed by you is 1 lakh or less. If it's up to 2 lakh, then 500. If it exceeds 2 lakh, then 1,000. Or in any other case, it's a blanket fee of 250. Say, for example, you are facing an issue of imposition of penalty. Now, threshold is not applicable. There's a flat fee of 250, irrespective of the amount involved. Time limit within 30 days of receipt of service of demand, notice of demand. So the moment the notice is served, within 30 days to be counted from that day, you have to file an appeal before the CIT appeal or the joint CIT. Now, in computing this period of 30 days, there is a period which needs to be excluded. Now, what is that? The application which is filed under section 270 AA, clause 1, before the commissioner, that period has to be excluded. Now, what is the logic? We all know the provisions concerning imposition of penalty under section 270 capital A, which deals with underreporting and misreporting of income. If an order is passed which results into variations, the assessing officer imposes a penalty. It could be 50% of tax liability or 200% of tax liability. We call it underreporting and misreporting. Now, if it's the case of underreporting of income, then assessee can seek an immunity from imposition of penalty by accepting an addition, paying the tax. In that case, even if the penalty is sought to be imposed, the penalty proceedings will be dropped, and assessee will be completely getting immunity from penalty. He can file an application and for immunity before CIT. Now, let's say the application is filed, but if the application is rejected, in that case, the assessee again will have to challenge the matter in appeal, and therefore logically they have excluded these dates the date on which the application is made and date on which the order rejecting the application is served to the assessee. Tax to be paid at the time of filing of appeal. Now, no appeal to the Joint Commissioner or Commissioner shall be admitted unless you pay the tax as per the income that is declared in the return of income. Now, one more aspect relating to the stay or payment of taxes, it will be, of course, part of the separate chapter, which is recovery of taxes. The circular says that if there is any addition by the assessing officer, then assessee can litigate further. He can file an appeal before CIT appeal. But then there is a blanket threshold that 20% of the tax demand assessee has to pay as a pre-deposit, and then balance 80% will be automatically stayed if the matter is pending before CIT. There are certain exceptions in which case the courts have held that yes, assessee is also kind of can seek a complete stay of demand by filing a petition. And in certain situations, there are also the discretionary power of the officer concerned where you can even insist on payment of 100% of the tax demand and not 20, or it can be more or less. So 20 is a bare minimum, but again, there are certain exceptions on both the sides. Procedure in appeal. So in the interest of time, we are not, kind of getting into it. And it's quite self-explanatory and very easily understood and presented in this material. So that's fine if we skip it. Appeals to the appellate tribunal. Now, in the hierarchy of appellate jurisdiction, the next one is the ITAT. Now, again, the question comes, which orders are appealable before the ITAT? All, the answer is no. It's only the specified orders. Now, what are those specified orders? Now, if you look at it, 115 VZC, power of AO to exclude a tonnage tax company from the tonnage tax scheme if the company is a party to any transaction which amounts to an abuse of scheme. Second, if an order is passed under a complete scrutiny or a reassessment, which is pursuant to direction of DRP. If an order is passed under 143.3 or 147 with the approval of commissioner, referred to in 144 BA, where the tax consequences have been determined under Chapter 10 relating to GAR. So if the GAR has been invoked in a particular case, in that case, of course, GAR is invoked only upon approval from the commissioner, and commissioner level officers would be involved into it. And therefore, you cannot file an appeal with the CIT appeal. The appeal directly lies to the tribunal. Naturally, if the order is passed by the CIT appeal or a joint CIT appeal under Section 250, the next course of action is to file an ITAT or appeal with ITAT if you are agreed. So Section 250 empowers you. Section 270 capital A, which is under-reporting and misreporting of income. So if that is the order passed, you can, of course, if it is passed by joint CIT and CIT appeal. Now the question comes, why would they pass it? If you see the powers of joint CIT and CIT appeal, one of the aspect covered in the provisions is they have the power to impose penalty as well. And that is where if the penalty is imposed by AO under 270 capital A, then the appeal shall lie before CIT appeal. If the penalty is imposed by the commissioner appeals himself, then appeal will lie before the tribunal. So likewise, if you remember, there are sections, for example, in case of charitable trust, if it wants to claim the exemptions and deductions prescribed under Section 11 to 13, it has to be approved under Section 12AA. Now, if the commissioner rejects an application for approval, then the only course of action is to file an appeal before tribunal. Likewise, ATG, Section 263. Now, that's what we'll discuss in a brief, after 5-10 minutes, and any rectification. Now, 154 is also a subject matter of appeal before CIT appeal, but if the order is passed by CIT appeal, then only the tribunal is the proper forum where you can file an appeal. So these are largely the kind of a scope of Section 250 appeal, not 250, before the ITAT, where the orders can be appealed against. And then we have time limits under Section 253. Before CIT appeal, as we know, the time limit is 30 days. And now before ITAT, the time limit is almost double, which is 60 days from the date the order sought to be appealed against is communicated to the SSC. Now there is a recent amendment in October with effect from October 2024. The time limit is again revised. The time limit is 2 months from the end of the month in which orders sought to be appealed against is communicated to the SSC. So you get a slightly higher time. Earlier it was 60 days from the date of receipt of order. Now it is 2 months from the end of the month in which order is sought to be appealed against is communicated to the assessee. On receipt of notice that appeal against an order has been preferred by the AO or the assessee, the other party can file memorandum of cross objection within 30 days of receipt of notice. Now, what is memorandum of cross objection? Any idea? Anybody would want to pitch in to explain what is cross objection? What is memorandum of cross objection? Any idea? All right. So the option of filing a cross objection is only available at the tribunal level. The option says that is you cannot file it before CIT appeal. So what this option means that if assessee has filed an appeal, then department can file an objection or a cross objection. And likewise, if department has filed an appeal before ITAT, let's say assessee wins at CIT appeal level, then as such assessee is not supposed to file any appeal. The department will challenge the CIT appeal order before the tribunal. And before tribunal, the assessee can also file a cross objection. It is not mandatory, it is optional, but it can be filed and generally it is preferred in certain cases. This is the fee structure. So we are not getting into it right now. Rectification. Now that's very important. Can the order passed by tribunal be rectified? Answer is yes. At any time within 6 months from the end of the month in which order is passed. Now, what is most important is there has to be a mistake apparent from record. You really cannot rectify an order with a view to kind of revisit the matter on merits. If it's a case of a mistake apparent from record, you can rectify it. Time limit, by which time ITAT is supposed to dispose of the matter. The ITAT, wherever it's possible, it will hear and decide the appeal. Now, the word written is wherever it is possible. That means the provision is directory in nature, not mandatory. If the matter could not be disposed of within 4 years, in that case, the ITAT still has a jurisdiction to adjudicate the matter and kind of deal with it. Let's talk about an interesting concept about stay of demand. Now, we all know that if you are appealing before CIT appeal, then of course the department says you pay 20% of demand and 80% will give you a stay, assuming all other conditions are satisfied. Now, let's say what if you lost before CIT appeal and now you're preferring an appeal before ITAT. If you win before CIT appeal, there's no question of stay, department will file an appeal before tribunal. But if you lose, you go to ITAT, then the question comes, because you have lost, department will kind of initiate the recovery proceeding to recover the demand along with interest, and it may also impose the penalty and recover it. Then the question comes, what about the stay? Now, the law authorizes the ITAT to grant the stay. Up to 180 days from the date of granting such stay, the ITAT has to. So let's read it verbatim. Under Section 254, Clause 2A, the tribunal can grant stay of demand of tax, which can extend up to 180 days from the date of granting such stay, subject to the condition that assessee deposits not less than 20% of the tax, interest, fee, penalty, whichever is the subject matter of appeal, or furnishes a security of an equal amount. Now, that's a 180 days. No extension of stay will be granted where the appeal is not so disposed of within the said period of stay as specified in the order of stay. So if it goes beyond 180 days, then the stay will vacate. Now then there is a caveat here. Unless the assessee makes an application and is complied with the condition of 20% and the tribunal is satisfied that the delay in depositing is not attributable to the assessee. The aggregate period of stay, if at all 180 days period is passed, can the tribunal go beyond 180 days? Answer is yes. But the aggregate period of stay of demand, which was allowed previously, and the period of stay so extended is not going to exceed 365 days, so 1 year in total. And the tribunal is then mandated to dispose of the appeal if it's a stay granted matter within 365 days in total. Now, the 4 year which was prescribed period, that is a directory period for an overall in general. So far as the stay granted matters are concerned, it says you have to dispose it off within 365 days. And then the law says if you fail to dispose of the appeal within 180 days or within the extended period of time, then the stay granted shall vacate after the expiry of such period, even if the delay is not attributable to the assessee. Now, this is the language of law. We will see some case study and then we will be completely clear about this provision. Appeals before the High Court. Now, formulate a question of law. This is the only thing which is worth discussing. Other than this, everything is quite procedural and self-explanatory. The question comes, what is substantial question of law? Let's try to understand this. Let me see. See, how it happens. If you are agreed by the order of assessing officer, you file an appeal before CIT appeal. There are no any conditions except that the order should find its place in section 246 or 246 capital. So this is very specific. Only again those orders you file an appeal before CIT appeal, and they have worked out all kinds of possibilities. In a case where the order is passed by CIT appeal, then again you have an ITAT. There is no any kind of examination you have to do so far as the issue involved is concerned. Whether it's a legal, whether it's a factual, doesn't matter. You can simply go to the tribunal. Once you are a tribunal and you get your judgment from the tribunal, then whether it is department or it is assessee, both can file an appeal before High Court if they are aggrieved. But when one goes before the High Court, the most important question is there is always an admission hearing that takes place, and post admission hearing the matter is taken up for hearing in a regular course. And that admission hearing, it's determined whether the issue involved is a substantial question of law or not. If it is not a substantial question of law, then the High Court is not going to entertain it. Now, if it's an issue about facts, ascertaining the facts, then this implies that the ITAT, and it's used quite extensively, that ITAT is called as a final fact-finding authority. So once ITAT has adjudicated a matter, and if the matter involves the ascertainment of facts or the questions of facts are involved, then you cannot take those matters before the High Court. The ITAT would be the last appellate jurisdiction so far as facts are concerned. But if the order of ITAT is perverse, or if the issue involved are debatable, if there are different, kind of on the same issue, there are different kind of views of the High Courts. One High Court is in favor, another High Court is against. There are contradictory views. If the issue is not settled, if issue is not free from doubt, all of this will culminate into a question of law, which on a case-to-case basis, High Court will enter. There is no standard fixed definition of question of law as such, but then there are judicial precedents which can be referred to while framing the question of law. Then finally comes the appeal before the Supreme Court. Practically, the order which comes from the High Court goes to the Supreme Court. But in that case, what is important is procedurally, one has to take a leave of High Court, permission of the High Court before going to the Supreme Court. So the High Court issues a certificate, okay, yes, this issue can be appealed against before the Supreme Court. Even if the High Court has delivered the judgment, but it has to certify the order as appealable before the Supreme Court. And customarily it is given, it's not part of the income tax law as such. but procedurally and just for the information. Now, what are the timelines? The timelines are different. The first is 30 days. If you want to appeal with a CIT appeal, before tribunal, it goes to 60 days. Before High Court, it goes to 120 days. And before the Supreme Court, the same is not statutorily mentioned under the income tax law, but it is based on uh, the codes of working and the rules of the court concerned. So I think identical question we are all familiar with. So I'm, in the interest of time, I'm skipping some small topics here. Revision of order. So let's touch upon this in little more detail. So what is revision? We have seen what is appeal. Appeal is where you are aggrieved and you go to the appellate jurisdiction to kind of file an appeal and dispute. Revision is something which has, two categories. One, revision of the orders which are prejudicial to the revenue. And second is revision of orders which are prejudicial to the assessee. Let's talk about the first one, the revision which is prejudicial to the revenue. Revenue here means the department. Section 263 clause 1 authorizes or empowers the Commissioner of Income Tax, Principal Commissioner or Chief Commissioner, who considers that any order which is passed by the assessing officer or the transfer pricing officer is erroneous insofar as it is prejudicial to the interest of revenue. That means the order has certain infirmities, it is erroneous, and that error leads to the, it is considered as prejudicial to the interest of revenue or the income tax department. In that case, he may pass the necessary directions, he may ask the officer to conduct an inquiry, and then based on that, a revisional proceedings can be conducted. What would be the outcome of revisional proceeding? It could result into enhancement of assessment, modification, or even the cancellation of assessment and direction for the fresh assessment. That could be the consequences. Now, the question comes, what do we mean by the term erroneous and error that leads to the order being prejudicial to the interest of revenue? Now, there is a deeming provision. Now, second point says the same thing. An order passed by the AO or TPO will be presumed, will be deemed, हम मान लेंगे कि वो erroneous है and it is prejudicial to the interest of revenue if, in the opinion of the commissioner concerned, the order is passed without making inquiry or verification. Assessment हुआ, assessment के दौरान assessee appear हुआ, assessee has filed the submissions, but there was no adequate inquiry conducted by AO, which in the opinion of the CIT should have been conducted. Second, if the order is passed allowing any relief without inquiry, assessee ने depreciation claim किया है बड़ा amount का, but assessing officer ने उसके related ना bill मंगवाए हैं, ना ही कोई inquiry किया. If assessee has incurred a huge travel expenses or assessee has incurred a lot of conveyance expenses, assessing officer ने logbook ही नहीं मंगाया. So all of this, kind of lack of inquiry will suggest that the order passed is prejudicial to the interest of revenue, and therefore one will have the recourse to the revision proceedings. And then there is a presumption that if it has not been made in accordance with any order, direction, or instruction issued by the CBDT under 119. Now, under 119, as you recollect, CBDT can issue the instruction direction for the benefit of assessee as well as department. The instruction issued by the CBDT are binding on AO to follow, but they are not binding on the assessee to follow because assessee is supposed to follow what is written in the law. If the department doesn't follow the instructions, in that case, that calls for the revision by the CIT. There's a time limit. No order shall be made after the expiry of 2 years from the end of the financial year in which the order sought to be revised was passed. Revision of other orders, that is section 264. Now, this section works in favor of the assessee, and it is one of the alternatives considered an alternatives of appeal. In case of any other order, the one which is not prejudicial to the revenue, passed by any subordinate authority, the commissioner can either on his own or on receipt of application from the assessee, he can call for the record of the proceedings in the course of which the order was passed, and after making due inquiries, the commissioner may pass the order as it thinks fit. That means the wide powers are given to the commissioner, and he can, kind of pass any order, make any direction as he seems suitable or fit into the case. So then there is an exception. The commissioner cannot, kind of revise the order if more than 1 year has expired from the date of the order sought to be revised. Now, which orders cannot be revised? One, if in relation to a particular assessment order, an appeal against the order lies before the commissioner appeal or the tribunal, but it has not been made and the time within which the appeal may be made has not expired, or in case of an appeal to the joint commissioner or tribunal, assessee has not waived his right. So you cannot, simultaneously file an appeal before CIT appeal and also opt for 264. You can't have a forum, kind of uh, undue advantage of a forum shopping, as we call it, that हम CIT appeal के पास भी जा रहे हैं, वहां भी issue pending है, likewise we just try कर लेते हैं, चलो commissioner अगर revision में इसको modify कर दे. You can't do the have the best of both the worlds. You have to opt for one only. Or where the order has been subject matter of an appeal, तो ट्राइब्यूनल अगर ऑलरेडी अपील फाइल हो चुकी है और नहीं फाइल हुई है और राइट वेव नहीं किया, दोनों केस में आप नहीं कर सकते. So this is the time limit chart. Revision of orders prejudicial to the interest of revenue, section 263. Revision of other orders, section 264. Revision which is prejudicial to the interest of revenue is 2 years from the end of the FY in which order sought to be revised was passed. And revision of other orders, which technically speaking are ones which are prejudicial to the interest of assessee, and they can be revised. In that case, the time is 1 year from the date of order. In case it's a suo motu revision, where the assessee submits an application, the time limit is 1 year from the end of the financial year in which the application is made. There's no logic for keeping the dates different for both the cases, but be that as it may, you have to remember the dates. So now the monetary limits for regulating the filing of appeal by the income tax authorities. What is the purpose of this section? The purpose of this section is to prescribe the timelines. Just 1 second. Now this section 268 capital A provides the monetary limit for regulating the filing of appeal by the tax authority. Now, what is the objective of this section? The objective of this section is to reduce the huge backlog of appeal. For small cases, the department cannot file an appeal before tribunal, high court, or Supreme Court. The cases involving specified thresholds. Now, what are those monetary limits as on date? And they have kept increasing these amounts, monetary limits, over a period of time, multiple times. And the limit that it stands today is with effect from 17 September 2024, the revised limit is department cannot file an appeal before tribunal if the tax effect does not exceed 60 lakhs. And for High Court, it's 2 crore. For Supreme Court, it's 5 crore. Earlier, it was 50 lakhs, 1 crore, and 2 crore. And this is not about the amount of adjustment or addition. It is about the tax effect. Just a second, there is. Now, there are certain exceptions where the decision to appeal or file SLP shall be taken on merits without regard to the tax effect and the monetary limit. So that means even if it's an issue involving an tax effect of less than 60 lakhs, it could be 1 lakh, it could be 2 lakh, or it could be 5 lakh. Still, the department can file an appeal before the relevant appellate jurisdiction, provided the conditions which we will be discussing are satisfied. What is it? Where any provisions of the Act has been held to be constitutionally invalid. Now, generally, this issue will come only when the matter has been adjudicated by a High Court. If the High Court says that a provision is constitutionally invalid, then the department, irrespective of the threshold, can file an appeal before the Supreme Court. Tribunal generally does not deal with the constitutionality aspects of a provision. The power to deal with it is only with the High Court and Supreme Court. Where any order has been held to be illegal or ultra vires the Act or otherwise constitutionally invalid. So therefore, any order, notification, instruction, or circular or the government has been held to be illegal or ultra vires the income tax law or even the constitutionality. So if the CBDT issues a circular and that circular itself is treated as constitutionally invalid or contrary to the Act, then the government can file an appeal before the High Court or Supreme Court. Where the assessment is based on information in respect of an offense which is alleged to have been committed under the specified laws, where the CBI is involved, Enforcement Directorate, DRI, SFIO. So all these investigative authorities are involved, then irrespective of the amount involved, one has to prefer an appeal. Where the case is one in which prosecution has been filed by the department and trial is being conducted in a court, where the strictures or adverse comments have been passed or cost has been levied against the department. So these are, kind of quite obvious where the department would want to challenge. So likewise, the list goes on, and in these circumstances, one will have to be cautious that monetary limit is not applicable. Department can prefer an appeal before the higher forum. Then what is the meaning of tax effect, and all of it is already there. So without wasting much of, time, we will now quickly, jump on to the one of the important part of our today's discussion is about the question and answer session. Yes. So let us try to understand the case scenario, and then we, I request the students to participate. They can give the answer in a chat box, or they can, simply raise their hand and we will unmute you and you can give the answer with the logic. So we'll give you 1 minute's time, 2 minutes time to read through the case law, and then we'll discuss the MCQ. So in this case, the return was filed with 18 lakhs as a total income. The return was processed under 143(1)(a). The income increased from 18 to 22. There was certain adjustment. Again, the regular scrutiny assessment was carried out, and the income of 22 lakh got increased to 35 lakhs. Once again, the reassessment was carried out, wherein the last or previously assessed income of 35 lakh got increased to 42 lakhs. So in a way, what was returned income was 18 lakhs. It got revised to 22 lakhs under intimation issued under 143(1). Then 35 lakhs and then 42 lakhs. Now, this is a case where 270 capital A clause 6 is not applicable. That means it's a case of an underreporting. You are supposed to answer question 1 to 5. Let's read what is the question. The first question is that assume that intimation was sent on 1st February 2026. Would such intimation be valid? What was the date on which return was filed? It was filed on 2nd December 2024 for the assessment year 24-25. That is, it was a belated return. And the intimation was issued where the income was got increased to 22 lakh. The date of issue of intimation was 1st February 2026. Whether the intimation is valid? Any answers? We have discussed in detail about the time limit for issuance of intimation under 143(1). It was towards the start of our session that we emphasized on the time limit. Any answer? A, B, C, D, you just have to select one of the answers. All right. So the correct answer is no, the intimation is not valid because it has been sent after the expiry of 9 months from the end of the financial year which the return was made. Let's go to the second question. For the purpose of answering this question alone, that means assume that the LLP has certain other income which had again escaped assessment and came to the officer's notice subsequently in the course of reassessment. So here we assume that the scrutiny assessment, the reassessment proceedings have been started validly, and during the course of reassessment, officer came to the it came to the knowledge of officer that there are certain other issues also which requires the reassessment. Then the question is, officer did not follow 148A procedure. Whether he was supposed to do or not, that's the question. Examine whether the action of AO is valid while making the reassessment in respect of such income. So you started the reassessment with one income, one issue. Reassessment was ongoing. During the process, you identified another escape. So you did not follow the process of 148 capital A once again, but you continued with your reassessment proceeding. And in this situation, the question is whether action of AO is valid in not following 148 capital A related process. Any answers? Is action of AO valid or not? Right. The action of assessing officer in this case is valid, and the logic is very clear that what is required is, and the section itself also mentions, if you read section 147, that if once the assessment has validly been initiated, in that case, any other issue which comes to the notice of assessing officer during the course of proceeding, he can also revisit, he can also make an suitable adjustment without he can carry out the reassessment without resorting to 148 capital A once again. Compute the amount of penalty to be levied under 270 capital A at the time of assessment made under 143(3). Assume underreporting of income is not on account of misreporting. Now, while we have not discussed penalty provisions, but we all know, we have all been thorough with section 270 capital A in our regular batch. So any answer anybody would want to have an attempt? So if I just briefly go back to the facts, the total income as per the return was 18 lakhs. It got increased to 22 lakhs pursuant to intimation. Post regular assessment from 22 lakhs to 35 lakhs. So there is an addition of 13 lakhs from intimation to assessment stage. And as compared to my original returned income, it has increased from 18 lakhs to 35 lakhs. So the question is, what would be the amount of penalty? So the amount of penalty would be, as you all recollect, for an underreporting of income, the penalty is 50% of tax amount. And this is a LLP. Now, assuming the effective tax rate of an LLP is 31.2%, which is 30% plus the education cess, that makes it 31.2%. Now, in this case, the addition that we will be taking is INR 13 lakhs, which is the difference between income assessed under 143.3 vis-a-vis income assessed under 143.1. So on 13 lakhs, we will calculate an effective tax rate of 31.2% and divide it by 2. The resultant figure would be 2,02,800. So the correct answer is option A. Let's go to question number 5. In continuation to, let's go to the descriptive question. Question 4 and 5 are very easy to answer, so I'm not touching upon it. XYZ Limited received a draft order from the AO as per 144C due to variation determined by the TPO in terms of arm's length price. XYZ didn't prefer to file an objection before the draft order before the dispute resolution panel. Instead, the company preferred to do an appeal before CIT appeal against the final order received from the assessing officer. Now the question is, you are supposed to advise the company whether their contentions are tenable and discuss the issue with reference to provisions of 144C. Anybody would want to make a comment, tippani, any answer? Now, if you recollect, Section 144C requires the eligible assessee. Now, the first thing is very clear, XYZ is an eligible assessee because there has been a transfer pricing adjustment. Now, they are supposed to file the objection within 30 days of receipt of draft order with the DRP. If the company fails to do so, then AO will proceed to complete the assessment on the basis of draft order after expiry of 30 days. And CBDT has also clarified that assessee has a choice whether to file an objection or not to exercise the option. So that is the discretion of the assessee, and it is the choice of the assessee whether he wants to go ahead with CIT appeal or not. Therefore, it's the company, it's the assessee, they can choose to file the appeal before CIT appeal is a final order instead of filing the objection before the DRP against the draft order passed by the assessor. So search question we are not addressing right now because we have not done this. So instead of that, let's take up the appeals and revision related. So let's go through the facts and issue involved. Appeals and revision. So the limited issue in this case is, what is the power of ITAT under section 254(2)? Can the ITAT recall its order and rehear the entire appeal on merits of the case? Now, if you see section 254(2) is limited to rectification of what we call as apparent mistake. So if there is any apparent mistake in the order of the tribunal, it can definitely pass a suitable order to remove the defect. But if it's a case which involves a complete revisit of its own opinion or review of the matter, in that case, recalling of the order is not permitted. And if ITAT has done so, that can always be subject matter of appeal or subject matter of review by the higher appellate jurisdiction. Now, this is about the stay matter that we were discussing a brief while ago, where we discussed that ITAT can grant a stay up to 180 days, and overall it cannot exceed 365 days. Just have a look at the facts, and then we discuss the issue involved and answer. And mind well, this is very, very important for those, kind of facing such issues in their practice. Of course, as a student, you might have come across many such matters during your articleship. So if you read the sixth line, it says the bench was functioning intermittently and therefore the disputed matter could not be disposed of. So what it means is that it was not because of the fault of the assessee, but it was because of the reason which is beyond the control of the assessee that the matter could not be disposed of within 365 days, and therefore the tribunal did not pass. Now, as per the law, the stay stands vacated, and therefore the assessee has to pay the demand. Now, assessee seeks your opinion as to whether the contention of the revenue is justified. That is, the stay is vacated and assessee has to pay the demand. Now, if you read the provision, it says 254(2)(a) provides that where the appeal filed before tribunal is not disposed of within the period of stay or extended period of stay, that means 180 days or 365 days, the order shall stand vacated after the expiry of 365 days if the delay in disposing is not attributable to the assessee. Now then, therefore, what the answer would be? The contention of revenue is not justified in this case. Why? The provision would result in the automatic vacation of stay upon expiry of 365 days if the tribunal could not take up the appeal. If what it means is if the delay in disposing of the appeal is because of the assessee, if I am taking, let's say, frequent adjournments, I am not appearing, I am not cooperating, I am not filing the required documentation, because of which the 365 days period got over, then I'm at the loser's end, I have to pay the demand, stay stands vacated. But the court says that if the delay in disposal is not because of the assessee, it is because of reasons beyond the control of assessee, it's not attributable to the assessee, then the stay will survive. And therefore, this is a classic case where the Supreme Court intervened in case of Pepsi Foods Limited. Let's discuss one of, I think, penalty chapter is still pending, but what we'll take up is the question relating to hyper limited. In case of hyper limited, the ITAT decided against the assessee and issued an order under 254. Assessee filed an appeal to the High Court by framing a substantial question of law. High Court, without framing the question of law under 260 capital A subsection 3 at the time of admission, issued the notice, heard both the party, and decided the appeal, affirming the order of tribunal in the questions which were raised by the appellant. You are required to discuss whether the High Court was justified in not formulating the substantial question of law as required and adjudicating merely on the question put forth by the appellant. That is the question. So, what is the issue involved? The issue is whether the High Court is justified in not framing the substantial question of law by itself and adjudicating merely on the basis of question put forth by the appellant. Now, as we discussed, what was important under Section 260 capital is that High Court cannot get into the question of fact. It's only when the issue involves a question of law that High Court can entertain it. In this case, the High Court has not done so, and therefore the Supreme Court, in case of AA Estate Private Limited, 413 ITR 438, the Supreme Court came to the conclusion that High Courts were not justified since it did not decide the appeal in conformity with the mandatory procedure prescribed in Section 260 capital A. Right? So I think with this, we conclude the today's revisionary class. And if there are any questions that the participants wish to ask, you can ask now, or even on 12th of November, that is day after tomorrow, where we'll be continuing with some other chapters which are part of the procedural laws, including TDS, TCS, and the miscellaneous penalty provisions and tax audit report related clauses. There you can definitely raise the questions that we need to have. Or today also, that's fine. We have 10 minutes to go. All right. So Manishji, we have no questions, so we can conclude. Yes, we can conclude. All right. Thank you. Good night.